The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone to Nova 401k Associates webinar, Common 401k Plan Errors with Steve Vest. Before we get started, I would like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions and handouts. This is where you will enter in any questions you may have for Steve. Keep in mind that the Q&A portion of this webinar will be held at the end, and Steve will answer any questions you may have as time permits. If time runs out and you still have questions, please send them to our email address, webinars@nova401k.com. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out the survey. This will allow us to track your time and participation. Certificates will be sent out within the week. To view any webinars that you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce you to Steve Vest. Steve is Vice President here at Nova, as well as a shareholder and the head of our Special Projects Department. Go ahead, Steve.
All right. Good afternoon, everyone, and welcome to our webinar here. This is a quick disclaimer that this webinar is not to be taken for legal or tax advice, and you should consult a qualified professional if you need that kind of advice. Also, as mentioned, if you need CPA credit, our no proprietor number is 009820. You need to register individually, be present for the whole webinar, and then complete this survey at the end, and then you'll get your certification. All right, so just a quick overview of the webinar today. We really want to go over identifying who is and is not a fiduciary, right? And then learn to identify some of the more common errors and problems related to 401k plans, how to avoid them, and then also how to correct them, because most of them are correctable, just a matter typically of time and money. This is a compilation of some of the more common mistakes that are both on the IRS's common errors worksheets, as well as things that we have seen in our practice where plans commonly go wrong. So initially, just a quick overview of the service model that we have with your firms. It's what we call sort of an unbundled arrangement where, you know, we've got several parties providing services. The TPA role is the role that Nova fills. We handle all of your compliance testing. We keep your plan document up to date. We help with loan and distribution review. And then we also prepare your annual government 5500 filing that's due every year. Also, you have your investment providers, whether that's John Hancock, Voya, Mass Mutual, Empower. I mean, we deal with quite a few partner firms. They actually provide the mutual fund platform. That's where the money goes to be invested into the mutual funds. They provide the 1-800 numbers of, you know, all the ability for the participants to transact and move their money around within their investment options. And finally, because both the investment provider and us cannot provide investment advice, you also typically have an advisor on your plan that can help with you know, specific investment advice if participants need help with their, you know, how to allocate their funds. They also assist with doing annual reviews on your plan and the investment lineup to make sure that you know, you've got the right number of funds in the right categories, that the fees are reasonable, and then help you with enrolling some of your participants as well upon request. So again, why are these errors that we're going to go over important? You know, what we find really is that operational failures are a whole lot more common than investment-related losses, even though, you know, in the news you hear about investment lawsuits and so forth. In the plan size that we deal with, which is small to medium-sized plans, you usually don't see lawsuits about the investments, but you can incur substantial penalties and fees to fix administrative errors and operational failures. Also, the fiduciaries bear personal liability for what we call fiduciary breaches. Not all of the mistakes that we talk about here are going to rise to the level of fiduciary breach, but they can still be expensive to fix from a company perspective. Just to give you some idea, the Department of Labor and the IRS do collect substantial penalties and fines each year, and we're definitely seeing an uptick in the amount of the penalties that they're assessing. If your 5500s are late, for example, if you haven't done your testing or you get audited randomly by the IRS, they can assess pretty significant penalties on the plan. Just to give you an idea, the penalties have increased almost like 200 or 300% over a couple of years ago. As you can see, the maximum old penalty for a late 5500 was $15,000. Now it can actually be up to $150,000. I haven't seen that yet, but we do commonly see the IRS send out notices for late 5500s that are $30,000. So we definitely want to get all of your things in on time and prepared in a timely manner. Again, all of these mistakes that we talk about are correctable under either the IRS's self-correction program, in which you don't have to file a specific formal filing with the IRS, or for certain errors, you might have to do what's called a voluntary compliance correction program filing, which is actually a special report that you have to send into the IRS to request a letter that they're in agreement with your fix or proposed fix. The VCP fees, if you do have to do a formal filing, fall into these categories, and it's all based on your plan assets. If your plan is $500,000 or less, the fee, just the application fee, is $1,500. If it's between $500,000 and $10 million, then it's $3,000, and then more than $10 million, the filing fee is $3,500. So who is a fiduciary? It's important to understand this because many parties in the relationship are doing work on the plan, but not all are fiduciaries. Okay, we're going to concentrate on the third one here, the 316 fiduciary, because that is defined as the plan administrator. The other two above are investment fiduciaries. These would be your investment provider companies, your investment broker, that advisor that we were talking about. They fall into the first two categories, so we're not talking about that today. But essentially, a fiduciary is any individual or company that exercises any discretionary control over the plan administration or control over the plan assets or renders investment advice to the plan. All right, so you can see the third one is where your investment advisor is being captured. So some examples include the investment advisor, trustees, the investment managers for the mutual funds that are in your plan, administrative committee members. Not all of your companies have an administrative committee for the 401k plan. It's not necessarily required, but if there is a committee making decisions about plans, plan decisions and plan design, that sort of thing, everyone on that committee is a fiduciary. All right. Plan administrators, the people that are handling the day-to-day operations of the plan, which is essentially whoever's doing that at your company is a fiduciary. I mean, whoever's approving the loans and distributions. Even though NOVA will, in many cases, help with the review, we don't actually approve. Like, we don't click the submit button. The individual that clicks the submit button is a fiduciary. All right. And anybody that hires or selects any of the above people is also fiduciary. That would be the owners of the company, people higher up that are making decisions at a company level. So the 316 fiduciary is defined as an individual who is a plan administrator. And typically they're not named in your legal plan document, all right? And when that does not occur, they're not in your plan document, then it's going to be the individual that's responsible for managing the daily operations of the plan at your company, okay? Some of the requirements or duties of a 316 plan administrator, and we'll go over more of these, may include distributing annual notices, summary plan descriptions. Those are the plain English explanations of the provisions of the plan that NOVA provides when we send out legal documents to you. These are not normally included in the rest of the enrollment materials that you provide to your employees or your newly eligible employees. So it's up to you to actually distribute those. Like, no one else sends those out. Approving loans and distributions we already talked about. So I won't go through all of these, but signing the 5500 that we send and prepare, sending in the contributions to the plan. All of these are 316 administrator functions, and typically functions that your company has responsibility for. So getting into some of the more common errors, the first one is the failure to amend your legal plan document in a timely fashion. So all of the providers, whether you're with NOVA or on a NOVA document, or even if you were with Fidelity or any other provider, all of us use pre-approved template documents. So the IRS every 6 years or so releases updates to these documents that basically have check boxes that make your plan unique. How long is your waiting period? What's your vesting schedule? All of these selections are just check boxes, and so long as you don't go outside the check boxes, you can rely on the determination letter that comes with those template documents that you have a qualified plan. But as I said, they do get updated typically every 6 years. Sometimes there are interim amendments that are required. Some require signatures, some don't, but all of these restatements do require a signature. And we're actually in a restatement cycle right now. It's called the tri-cycle restatement period. And all documents with all providers are due by July 31st of this year. So we, at NOVA, this is something, we prepare these for you, but they're sent out for your signature and need to be executed in a timely fashion. So keep an eye out. I'm sure a lot of you have already adopted these because we're not just sending them out right now. We've been working on this for the last, at least 15 or 16 months to get ahead of the game. So, what happens when you don't sign an amendment on time, right? If, for example, if one of the interim amendments, in this case, a few years ago, there was one called the Final 415 Regulations Amendment, is sent out, and you're told to adopt the amendment by the due date, in this case of July 31st, 2008. It's obviously that one goes way back. And all of a sudden it just gets dropped. Somebody doesn't adopt it in a timely manner. There is a fix, but it does require a voluntary compliance program filing, which again costs money, right? Depending on the size of your plan, you might have to pay $3,000 to request approval by the IRS for an untimely, what we call an untimely amender. Right? So it is fixable, and the IRS does tend to more or less rubber stamp these approvals. So we never had a problem with them not approving one, but it costs money is the problem for adopting it late. Another error is the failure to sign up all of your affiliated employers. So again, in these legal documents, only companies, think about it as EINs, right, which have executed participation agreements to the legal document that we prepare are actually permitted to participate in the plan. So if you've got more than one company that's in a related group, then and you want all of those companies participating in the one plan that you have, they all need to sort of sign up. It's think about the participation agreement as a sign-up form. Okay. Now, what is a related group? There are a couple of different kinds here. We've got, the fulfill the control group standards. We've got parent subsidiary, which is companies owning companies. So when one company owns at least 80% of another company, then the IRS views both those companies as a single employer for plan purposes, and you would generally want to sign up all of the companies to a single plan. All right. A similar kind of control group is called a brother-sister control group, in which this is individuals owning companies. So if the same 5 or fewer people, individuals, commonly own at 80% or more of 2 companies, again, you've got a related group, and all the companies should be participating in one plan. If you're not sure if all of your companies are participating in your plan, contact your NOVA account manager, and we can check your document, because we should see participation agreements for all of your EINs, right? Also, read all of our correspondence. When almost all of our documents now go out with DocuSign emails, so that's how you'll see the documents and the emails going out for signature to your trustees. So people need to be paying attention. Normally, we send out these emails to not only the trustees, but we'll CC whoever the primary contact for your plan is in our system, so that you also know, because typically whoever's administering the plan is not typically the one necessarily signing the document and or amendments. And I know the owners of companies sometimes are not watching their email boxes very carefully, so we just want to make sure. We send out plenty of reminders, so just keep an eye out for those. Also, if you ever have an acquisition or considering buying somebody, I highly recommend that you contact us immediately, preferably before the acquisition, so that we can look at the control group structure, determine, is it going to be a control group? Is it not? What do we need to do with the plan in terms of operation? Your choices in what you can do after an acquisition are much more limited than if we know about it beforehand. So this is one of the most common errors, which is failure to follow the provisions in your plan document. So the IRS requires that the terms of the legal plan document, what's in the check boxes and legally you're supposed to be doing, is actually done in practice, right? And if you don't, then you have what are called operational failures that have to be fixed, and not fixing them is not an option. The IRS upon audit could disqualify the plan. So, for example, failure to follow the plan's definition of compensation. Again, what compensation you're using and applying your employee deferral elections, the matching computations if you're doing a match, all of this is defined, this compensation is defined in your plan document. All right. And if you are doing something differently in payroll, like you're applying or computing your match on the wrong definition of compensation, it's going to result in your participants getting the wrong allocations, right? The wrong amounts of match. You may be excluding certain aspects of their pay from their ability to contribute or defer upon. And again, these are problems that have to be fixed, and we have a special projects team that does a lot of this correction work. So just so you know, most plans that we draft, we define compensation as total gross W-2 pay. All right, excluding bonuses, commissions, any number of other items is permissible, but it has to be in your plan document, and it may also be subject to some special testing, because you can't just exclude whatever you want without having your compensation definition tested for discrimination, right? So again, if you're not sure what your definition of compensation is, then definitely call your NOVA account manager, and they can look up your document and tell you exactly what it is, and you can compare it to what's in payroll. So for example, if you've got a matching formula and you program your payroll system to calculate the employer match based on base pay, which is, might exclude overtime, bonuses, and your document actually is defined as gross pay, then you're going to have to fix that problem. And you can normally fix it by self-correction, right? So you don't have to do a formal filing, but it involves going back and making people whole or applying, your match to those excluded items that you weren't permitted to exclude, right? You've got to follow the plan document is the key concept here. Again, we want to make sure we understand what is in our plan document. The definition of comp is also in the SPD, the summary plan description, which is a more plain English version of the legal document. Again, just call your account manager if you don't know what, or you want to confirm what your definition of pay is. And just make sure that whoever's running your payroll and, setting up matching formulas and whatnot is properly trained to understand what the plan provisions are or how to look them up to make sure your payroll system is consistent with what, again, is in the legal document. Another operational problem is, not letting your people in on time, right? So again, it's the plan document and the waiting period in the plan document that's important. It doesn't matter what your HR policy is. It doesn't matter what your offer letters say, right? In determining who's eligible for the plan. And quite often we will see employers letting people in either early or late. I mean, we see both problems. And let's see here. So for example, if you have no agent service waiting period, and you don't offer Steve enrollment for 6 months, you've got a problem. And what do you have to do? You're going to have to go make Steve whole for the employer contributions and part of the employee contributions that he would have made for the period that he was improperly excluded from the plan, right? Because you didn't offer it to him right away. Again, and who pays that amount? It's going to be the company, right? You have to give them the contribution plus some earnings. Just to get into some initial eligibility training to help you prevent or at least know how to apply some of the waiting periods. We'll start with the maximum waiting period that's allowed by law. So you cannot make anyone in a 401k plan wait more than a year at age 21 with a minimum of 2 entry dates. And we'll see how this works here in a minute. That's the maximum amount of time you can hold somebody out of your plan. And typically they have to work a certain number of hours within this period of 1 year. And the age requirement can never exceed 21. Also, the initial computation period is the 12-month anniversary date. It's computed from the original date of hire to the 12-month anniversary date, which is typically going to cross a calendar year. So just so we understand and see how that works a little bit better here. If we have somebody hired, I'll use my pointer here. If we have somebody hired 6/1 of 2019 and you have a 1-year wait with a 1,000-hour requirement in your plan, okay, and then 2 entry dates. So most plans are calendar year. If you have 2 entry dates, your entry dates are typically going to be 1/1 and 7/1. All right, that's the most common setup. So the initial computation period by law has to start from the original date of hire and go to the 12-month anniversary date, which in this case would be 6/1 of 2020. And we ask the question, did the person work 1,000 hours in this period right here, which is crossing plan years, right? If the answer is yes, they are credited with 1 year of service on the 12-month anniversary date, okay? Not the moment they worked their 1,000th hour. But, so they get 1 year of service credit here, and then you would want to offer them, but they're held out a little bit longer because the entry date in this case is the next entry date is 7/1. So on or before 7/1, you want to give them their enrollment materials and their summary plan description, and allow them to deduct from payroll immediately after that date, whatever your first available pay date is after that. If the answer is no, maybe they worked 500 hours. To make this computation of hours and not having to cross calendar years, if the answer is no, the next computation period shifts to the calendar year, right? Just to make it a little easier. And each year after that, you're asking the same question and watching for, does this person work 1,000 hours in any calendar year after this? The moment they do, right, again, they're credited with 1 year of service on their anniversary date. So if this was 500 hours, they would not get in 6/1, but let's say they worked 1,000 or more in 2020, their eligibility date would then be 1/1/2021. So they would get in the next year. So that's how the 1 year wait works. Shorter periods are okay. We have a lot of plans that have everything from immediate entry to 3 months, 6 months waiting. For these periods, you're not counting hours. You don't have to worry about hours. It's on what we call an elapsed time basis, and there are service spanning rules. So what that means is, again, start from the original date of hire. If you have a 3-month wait, go to the 3-month anniversary date from the original date of hire and ask the question, are they employed on that date? Doesn't matter how many hours they worked in between. It doesn't matter if they were hired on one day and worked just one day, terminated and came back right before their 3-month anniversary date and worked 2 days in the total period. They get all 3 months. There's no continuous employment concept here. So it's real easy. Just original date of hire, 3-month anniversary date. Yes, they're employed, they're eligible. And you let them in on the next entry date. Okay? Obviously, this is not very effective for keeping part-time employees out, right? So, all right, for example, we have a plan sponsor, okay, so this is actually excluding a class of employee. All right. If you have an exclusion in your document, I think I might have skipped over, let me go back real fast. No, I guess I didn't. Thought I skipped a slide. Excluding certain classes of employees from your plan is also okay, but it has to be written into your plan document. So if you're excluding field workers, or you want to exclude hourly employees or something like that, that may be permissible. It's subject to some additional testing, I can tell you that for sure. But it also has to be in your document. If your document doesn't say you're excluding part-timers or hourly or whatever category you want, then you're not supposed to be doing that. And if you are, again, we've got to fix that problem, which usually involves going back and giving extra contributions to those individuals. So, a common exclusion, or fairly common exclusion we do see in plans, is to exclude part-time or seasonal employees. Well, I mean, the IRS does not like service-based categories like this at all, part-time or seasonal, because they view it as a circumvention of the 1 year waiting period. Because just because you say somebody's part-time, they could work 1,000 hours, right? Part-timer can work 1,000 hours, and you're excluding them from the plan continuously when they would otherwise be included under the 1,000-hour 1 year rule, right? And the IRS does not like that kind of exclusion. So much so that they have passed new regulations now. All right, so get ready. Right now, the IRS has new regulations regarding what they call long-term part-time employees. I'm not going to go into this in great detail here because we had a webinar 2 days ago on this specific subject. And again, that recording will be up probably in a day or two if you want to go back and listen to that webinar. But in general, starting in 2021, which is last year, we start counting hours for people, and anybody that has worked 500 or more hours in 3 consecutive plan years. Okay, so it's basically a continuously part-time person, right? So maybe they're working 500 to 1,000 hours, and they've been with you for years. You will no longer be able to exclude this person after this 3-year counting period is up. So, if you think about it, they're only having you count 500, this 500-hour requirement starting in 2021. So you got 2021, 22, 23. So by 1/1/2024, you will have to offer even those people, even if your plan says you exclude part-timers, you're going to have to offer at least enrollment. You may not have to give them the employer match and some of the employer contributions, but you're going to have to at least allow them to defer to make employee contributions into your plan. And that's not that far away. So if you've got a plan that has continuously part-time people that fit this idea of working more than 500 hours, but you're excluding them because they're part-time, you might want to call your account manager, and then we'll try to figure out what options you have on plan redesign, because you're not going to be able to exclude them anyway. So again, just to be aware of what your waiting period is. I mean, this is one of the more important functions that you as an administrator at your company have to perform. I mean, NOVA does not do this for you, and unless you've got your investment provider, your record keeper like Hancock or Voya, doing eligibility tracking for you, and most are not, because unless you're feeding them a full payroll period, like all of the data in your payroll, every pay period, which very few firms do, they're not tracking your eligibility either. So it's up to you to let your people in a timely manner. So you need to know, what is the waiting period, how does it work, and how are you determining who you offer the plan to, so you do it in a timely manner. Also, don't exclude any classes of employees unless that's in your document. Again, if you're not sure what's in your document, call your NOVA account manager. We can tell you. We get a lot of questions on dealing with rehires. So, what do we do with rehires? So, if the general rule is fairly easy. If a formerly eligible employee ever had a single vested dollar in the plan, whether it's employee contributions, match, it doesn't matter, then they never lose their prior service credits. Okay? Otherwise, if maybe somebody was eligible and never contributed, there was never a dollar in the plan, they would lose their prior year service credits after 5 consecutive years. All right. So it's usually pretty rare that rehires lose their prior service credits. So if you had somebody that had the 1-year wait completed, 3 years ago, and now you rehire them, you should allow them to participate immediately on date of rehire. You should offer them the plan immediately. They don't have to wait another year. They don't have to wait for, even if they rehire and you've got your next entry date 4 months from now, they don't have to fulfill that either. You should offer them the plan immediately. There's often confusion between service crediting for vesting and service crediting for initial eligibility, right? Your initial waiting period. So by law, the initial eligibility or waiting period has to be credited from the original date of hire, always. So just like we showed in that example, you just start with the original date of hire and then you apply your waiting period. Vesting is a little bit different. It's applied on a plan year basis. Most plan years are calendar years, right? So, somebody typically is going to have to work 1,000 hours in a calendar year to get 1 year service credit for vesting purposes, right? So vesting is how much of the employer contribution do I get to keep if I leave the company, right? If I'm 20% vested, I get to keep 20% of the match. That's the concept with vesting, right? There's also some confusion on service crediting, what we call a year of service accrual requirement for receiving employer allocations. So some of you that are making employer matches and employer profit sharing can put additional requirements on an otherwise eligible employee's ability to get the contribution. So I've fulfilled my 1 year wait. I'm actually contributing to the plan. Plans can also have an additional requirement that you be employed on the last day of that particular calendar year or plan year in order to get the match, right? Or that you work 1,000 hours in that plan year to get the match or the profit sharing. So that's not quite the same as your waiting period, but it's just additional what we call allocation requirements for who gets the employer contributions. So, don't confuse those two concepts. Loans are very popular provisions in plans. They are subject to certain rules. They can't exceed certain maximum dollar amounts. We'll go through a few of these, but we do see a fair number of plan loan failures. The loans have to meet certain payment schedules, and if loan repayments are not started on time, that's probably the most common error we see with loans. Somebody takes a loan and it just doesn't get picked up in payroll. But what happens, like if you've missed loan payments, or that happened and you just didn't get into payroll on time, the delinquent loans either have to be defaulted, if you've got a delinquent loan, you have to either catch up the loan by making up the missed payments, or it would need to be refinanced, right? Because the legal time frame for repaying a loan is generally 5 years, and if you missed a month's worth of payments, you can't just pick up the payment that was part of the original loan and just start it late, because it'll never get paid off by the required maturity date of 5 years, right? So we've got to find a way to get it back on track, or cure it, as this bullet says here. And if the loan is not cured by the end of the quarter following the quarter in which the first loan payment was missed, right? Then you have to default the loan, which means it would be considered taxable income to the participant. Your investment provider would issue a 1099 showing it as taxable income, and it would also be subject to any 10% early withdrawal penalty if the person is under age 59 and a half, right? So it's required to be defaulted. Some of your investment companies will send you notifications on delinquent loans, so that you can be aware of loans that have received no payments. Some do it automatically, others don't do it at all. So it just depends on your investment provider. So again, part of the cure is either catch up the loan payments, completely pay the loan off, or re-amortize it, right? If you refinance it, for the shorter period, the loan payment goes up and it gets paid off on time. Otherwise, you have to default the loan. To fix it now, I need to update this bullet. It used to be that you had to do a formal filing with the IRS to fix a loan that was after the cure period, which means you're required to default it. And you don't want to default it, right? You want to somehow refinance it and get it back on track, but you're past this 6-month cure period, right? You used to have to do a formal filing. Luckily, you don't anymore, but we still do need to fix it. They will allow you to self-correct a loan failure after the cure period, which is nice. That's fairly new. So I've kind of given some examples here. For the sake of time, I'm not going to go through this one, but again, this is like, somebody takes a loan, somehow payroll or HR missed it, and they didn't get it started on time. We've got to either default it or get it current, right? Similarly, the maximum loan amount in total that anybody can take is $50,000. So if somebody takes $60,000, then what happens? That excess $10,000 has to be considered a taxable distribution and is also subject to early withdrawal penalties. So these limits are things that your investment provider and NOVA, as part of our review, look for. So really the most common mistake is somebody takes a loan and you don't get it started in payroll, which that part we cannot, none of us can control. That's on the companies and their payroll systems. So just keep an eye out for your message centers from your investment providers. Many will issue delinquent loan reports and then put them out there for your download. I would periodically review your payroll system to see who has a loan, and at my record keeper, Hancock, Mass Mutual, whoever it is, and then compare it against my payroll system. Now, obviously, if the individual terminates, like they're gone, then naturally you're not going to continue to make loan payments. That's normal. That's not what we're talking about. I mean, those loans eventually will have to be defaulted within, for somebody that's terminated, when they take all of the rest of the money, the loan would automatically be defaulted by your investment provider. But if they leave their money in the plan, those are the ones we have to watch out for, because we may need to go through a special process just to get the loan defaulted within the cure period. You don't want a loan hanging out there for somebody that's left all their money in your plan indefinitely. So another important function that falls to the company is to get the employee contributions and the loan repayments that you are deducting from people's pay into your investment providers in a timely fashion. Okay, so the Department of Labor created a safe harbor time frame for small plans. So if you're a small plan with less than 100 eligible people, then you have 7 business days to deposit the money, and get it out of your general ledger over to your investment provider or your mutual fund provider. Okay, this doesn't apply to your employer contributions. Those have much longer, but the employee parts of the contributions, which are the employee contributions and the loan repayments, have to fulfill this standard. If you're a large plan, because the Department of Labor expects large plans to be a little bit more on the ball and have their processes outlined, gives you less time, but it's a very kind of gray area rule, which is as soon as administratively possible. It goes, but not later than the 15th day of the month following the deduction or the pay date. You can forget that second bullet. I mean, they want it in as soon as administratively possible. And when the Department of Labor comes in to audit, they're going to look at all of your different, how you process other things, like how soon do you get the withholding over to the government for that particular pay period. I mean, if that's going, 3 days or 4 days after your pay date, then why they'd be asking the question, why are you holding on to the employee contributions for 2 weeks, right? So it's a huge DOL audit. That's almost exclusively what they look for when they come to audit you, is late contributions. And also, if you're a large plan, your independent CPA that audits your plan also looks for this. Okay. So typically, you're going to get anywhere from, I would say, 3 to 5 business days. But be consistent. If you're sending all of your contributions in, or most of your contributions in 2 days, and then you have like a couple of 6 or 7 day outliers, those are probably going to be considered late, based on your administrative practices, right? So just an example, we have a company that fails to deposit employee contributions for 3 months at the deduction date. What do we have to do when contributions are considered late? Well, we have to compute lost earnings and deposit them to those individuals in your plan. So you're making them whole for the lost earnings while you held on to the money. And also there might be a 5330, an excise tax penalty that has to be paid depending on the amount. Typically, that penalty is 15% of the interest amount that's owed. So again, contributions, you're having to send in, the employer is having to make up money to the plan and or pay penalties whenever you have these operational problems. So how do we avoid this? Just make sure you understand, am I a large plan, am I a small plan, and what is my applicable deadline? Again, small plans, 7 business days. Large plans, I was probably try to get it in 3 to 4 business days. I've never seen the Department of Labor challenge that, to be honest. And we've dealt with a lot of the audits, but I'd say those are the good standards right there. Set up good procedures to ensure deposits are made, by these particular dates, and have your backups in payroll in case your regular individual who processes payroll is sick or out on vacation, right? This is obviously a problem for smaller companies, but if you have multiple payrolls, make sure you're checking them all to make sure they're going in on a consistent basis. And again, be consistent. If you're going to get them in 2 days, get them all in 2 days. You don't want some being 2 days and then 4 days and then 6 days and all over the map, right? Just be consistent. Another problem we run into are companies putting the wrong types of contributions in the wrong source at their investment companies. So by law, you have to keep the different sources of money separated out, okay, and going into the right buckets, if you will. So, for example, if you look at your benefit statements, you've got an employee contributions line item, you've got a Roth contributions line item. Again, why? Roth is after tax, and your employee deferrals are pre-tax. You've got a matching line item. You've got safe harbor if your plan's a safe harbor match. You have to keep these separated out properly because, again, the safe harbor match, for example, is 100% vested. Your regular matching source is usually subject to a vesting schedule. So if you start commingling money and when you're making your deposits and you put them in the wrong buckets, then people are going to get paid out incorrectly. And we do see plans doing this. Typically, it's going to happen when a plan changes from one type of employer contribution formula to another. So, for example, if you have a plan that goes from safe harbor to non-safe harbor or vice versa, right? A lot of times what we'll find is, if you weren't safe harbor and you changed to safe harbor in the following year, like in 2021 you were not safe harbor, and then in 2022 you decided, I'm going to do a discretionary match, and whoever's running payroll just keeps depositing the money into the safe harbor source, you've got a problem. We need to fix that, otherwise people are being paid out wrong in 2022, right? Setting up your contribution limits properly is a good way to prevent problems, right? And again, these are limits that NOVA checks for you when we run your testing, but it's much better if you can proactively make sure that the errors don't occur. So for 2022, if someone is under 50, they get to put $20,500 in employee contributions, and somebody that's 50 or older this year, at any time this year, is eligible to put an extra $6,500 in there. So you need to combine your Roth and your pre-tax together. You don't get to put like $20,500 in Roth and $20,500 in pre-tax. That's the total for all the employee contributions. So you want your payroll system summing the Roth and pre-tax together and then being limited to these two amounts. Basically, you've got $20,500 for somebody that's under 50, and you've got $27,000 for somebody that's 50 or older this year. So make sure your payroll systems are set to catch that. Similarly, matching contributions need to be limited, and the reason for that is because there is a maximum compensation cap each year. For 2022, the maximum amount of pay or gross pay that we can count in the plan legally is $305,000 for this year. Sometimes the IRS indexes this and changes it. Typically, it moves up. But just to show you an example of what I mean, again, you'd want to set a limit in your payroll system for the match. But let's say that you have a 50% on the first 6% formula, discretionary formula, then the maximum amount that any one individual can ever get is $91.50. And we get that by taking the $305,000 and dividing it or multiplying it by 6% and then by 50%. Right? So you should never have somebody that gets more than $91.50 if that was your formula. This one's a more common one. A lot of you have safe harbor plans, so this will be useful. The limit on the safe harbor match this year, if you've got your standard formula of 50% on the first, 100% on the first 3%, and then 50% on the next two, right? So basically your formula caps out at 4% on the high end, right? Then $12,200 is the most any one person should ever get. So if you got somebody making $600,000, you don't give them 4% of $600,000. 4% of 300. This says 304. Excuse me. That should be 305. Typo there. All right. And any amounts over those will have to be forfeited. Again, we look for that on the NOVA end, but we're not going to catch that until you submit census. We run it, which will be in the following year, right? And in the meantime, one of these highly paid people could have left the company in the first quarter of the following year before we get to this part of it, and then they took all the money, including this excess you gave them, right? Again, just make sure you've got all your dollar caps and your payroll system set up right. Even though we look for them, it's much better if you can just handle it and make sure they don't exceed the limits up front. You don't need separate catch-up and non-catch-up fields in payroll. You know, for that 6,500 that we were talking about before, there's no need for that. And you certainly don't want to be applying your matching formula separately if you do have separate fields, right? Because then you'll overmatch people if you do it. The catch-up and the non-catch-up is just added together for purposes of all of these different limits. All right. We send out, it says monitor contribution limit changes from year to year. We send out something to all of our clients right after the IRS releases the new limits, which is typically in December of each year for the following year. We send you an email indicating here are the new annual limits so that you can update your payroll system. So watch out for those emails and just call us if you have any questions. I'm going to skip over a little bit of this, but you know, failure to distribute a lot of the required notices. Most of these notices fall to you as the employer to distribute. Some of them go out, like the fee disclosures typically are included in the enrollment packages, but then there's a requirement to send out fee disclosures annually, right? And in many cases, you as the employer are responsible for sending out the annual notices. So the safe harbor notices have to be sent out. Again, if you're a safe harbor plan, if you're automatic enrollment, there's a whole bunch of notices that really a lot of employers are not aware that it is their responsibility to send out the notices. You do get some help from different investment providers, but they never cover all of the employees that are supposed to get these notices. For example, terminated employees who are gone and left their money in your plan are supposed to get the fee disclosure notices. Yeah, those may not go out automatically. So your forfeitures, right? Your non-vested piece. When somebody takes a distribution and they're not 100% vested, what happens to the money? It gets transferred to a holding account at your investment provider called a forfeiture account, and then you can use that money to pay routine administrative expense, or you can reallocate it back to your employees, or typically what firms do is use it to offset some of their ongoing employer contributions. All right. The one thing you need to keep in mind is you never, even if your investment provider sends you something saying, hey, do you need a check back from your forfeiture account? Your answer is always no. This is a prohibited transaction. Money cannot revert back to you as the employer out of the plan, directly to the employer. So just keep that in mind. So again, we've got all these rules and all these notices that have to go out. You know, what can you do, right? You could retain an administrative 316 fiduciary, right? You hire an expert that's outsourced that essentially would be like an individual sitting in your company, right, that knows all about 401k plans and administration and can, you know, they're going to know all the rules and keep you on track with them. And obviously this saves internal staff time. It'll save money. I mean, there is an additional cost. So the AFS brochure that was in the correspondence we sent on this webinar is that type of company. The owners of Nova 401k Associates realize that, you know, employers need help with the things that they're responsible for, and that company is set up as a fiduciary to take over certain responsibilities that you have, right? So if you've got a smaller company and you don't want to deal with most of the operations of the 401k plan, you know, you can hire an outside party to help reduce that liability, because again, to the extent that, you know, either you or this administrative fiduciary that you hire messes something up, it's that party that's going to have to make up the losses to the plan, right? So it's a way to reduce your liability and avoid operational mistakes that we've been talking about. A lot of people think that Nova and even some of the other administrators that deal with 401k plans are fiduciaries, and we're not. You know, we're just handling ministerial duties. So we're like an accountant. Nova prepares your 5500. We prepare your annual your non-discrimination testing each year. We review loans and distributions, but we don't approve or sign off on any of those things. You guys do. So that the fact that you're actually signing these things makes you responsible for them in a fiduciary capacity that Nova is not, right? So again, AFS, a lot of this is in the AFS brochure, so I'll just kind of skip over a lot of it, but these are some of the different levels of items and functions that Administrative Fiduciary Services, Inc. can take over for you if you're interested. Right, we got the basic level. If you just want notices, you know, handled, they can handle that. Partner level is the most robust, which we recommend, which includes Administrative Fiduciary Services signing all the proper forms. You know, if you have refunds for your plans, they'll sign the refund forms, make sure they get in on time. They'll be the ones harassing Nova and other TPAs to get the testing done on time, right? Make sure there's no penalties. So this has the most robust suite of services. If you're interested in hiring a 316, if it's of any interest, you can contact Araceli Valdez at AFS, and I think there's also probably in the brochure. I don't know if we have any questions. We run a little, well, I guess we're right on time. Might have time for a couple of questions if we have any.
Yeah, it looks like we have about 7 questions. First one would be regarding who is a fiduciary. You stated if a person is not named, is that person who is responsible for the day-to-day operation of the plan is a fiduciary. Does that mean if an owner designates his secretary to run the plan for him, does that mean she is considered a fiduciary and can be held liable for plan errors?
Great question, and the answer is yes. And that's the thing that most people don't understand, right? Like the trustees and the owners are not typically the ones. They're fiduciaries as well, but when they delegate functions like signing off on loans and distributions, and again, discretionary functions, right? Then those individuals are fiduciaries and they don't even know it, right? Like ultimately though, if somebody's paid out wrong, or so some of these operational problems, let's say we pay somebody out wrong because the vesting was wrong on a distribution form or the contributions were sent in late. Those are not fiduciary breaches. So that doesn't mean that they're going to come after the secretary for the money, but the company is going to have to cough it up for sure, right? Well, these are relatively, they sound like major errors, and some of them can be pretty costly, but they're not like, a fiduciary breach is really at another level. Like I've stolen money out of the plan or something of that nature, you know, like other people's money. But yes, that individual is a fiduciary.
Okay. Next one is, if you started a new plan last year, 2021, do you have to reinstate this year?
If you started your plan recently, and there's a way to look at the document, right? We just have to look at it, but all of the new plans are these tri-cycle restatements, the latest versions of the document we've been using for all the new plans that we've been signing up since I think at least the beginning of last year. So the answer would be no if you're really a recent client. But if you're not sure, you should be able to look at your document, and if the copyright date is, I don't have one in front of me, but I think it's like 2020 or 2019 or something like that. There's a little copyright down at the bottom left, then that's the most current document. That's the best way to tell. Like if your copyright date's way back in like 2010 or 12, that's the previous version. Again, it is our responsibility to monitor all of our clients and make sure we at least supply your restatement to you in plenty of time for you to sign it on time, right? I mean, we're not a fiduciary in that regard, but I mean, that's our job to prepare and get that into your hands on time. So.
All right. What is the minimum age to enter a plan?
21. You cannot make, it cannot be more than, the minimum, there is no minimum. Obviously you have child labor laws in effect, right? But I mean, the maximum age is 21. There is no minimum. They just have to be legally old enough to work.
Okay.
For your, yeah.
Next one is, could an employer have employees who are long-term part-time, who are HCE and enter the plan under the LTP2 rules, who defer the entire 402G limit among with catch-up and be ignored for ADP testing purposes? If this is true, there would also be an employer benefit for top-heavy, since the long-term part-time amounts are included in the TH test, correct?
Well, that's a very technical question from one of our clients. I think somebody else is listening in to this webinar. So long-term part-time employees have to be allowed to defer, to make employee contributions. But they're excluded from many of the other requirements in the plan, and a lot of the testing as well, right? So you've got I mean, there's 4 or 5 non-discrimination tests, which I didn't even get into in this webinar, but they're excluded from those. And then I don't think an HCE would ever get in, right? I mean, you're talking about somebody that's working, that's part-time and highly compensated. I guess it's possible, but since they can defer, I mean, of course they can get in, you know, the maximum. And I'd have to, again, the webinar on long-term part-time employees goes through a lot of these rules and what tests they're exempt from. So I don't want to say something wrong here and contradict that, you know, like what tests are they excluded from? I think what somebody's getting at is, can I be part-time, long-term part-time highly and not be in my ADP test and somehow, you know, improve the results is probably what I'm thinking there.
All right. The next one is, after 5 years, they could lose eligibility. Is that stated in a plan document?
Yes, the break-in, they don't. It's not really that they lose eligibility. Well, I guess that's one way to put it. I mean, they have to requalify. So under your waiting period, if you've had their prior service credits lost after a 5-year break, but those rules are in the base document so our plan document comes with an adoption agreement and in a much longer base document that has all the standard rules, which include the break-in service rules. So yes, it is in your document in terms of the break-in service, right?
Okay. Next one is, if late contributions, do you have figure out an interest they could have earned? Do you what?
I mean, if the question is like how much is the interest, I mean,
Gotcha.
when we correct late contributions, Nova will use the hire of basically the Department of Labor. The Department of Labor has a calculator that calculates the lost earnings based on some IRS underpayment rates. Like if you don't pay the IRS on time on your taxes, it's the interest that they charge. Usually it's between 3 and 5% or 6 in some years. It varies by quarter, but we use that calculator to compute the lost earnings. If that was the question, I'm not sure.
Yeah. Okay. Very last question is, how do you calculate lost earnings?
Well, that was it right there. So
okay.
The Department of Labor has a calculator where you indicate what the late date is, what the pay date is, the amount of the actual payroll that was late, and it'll calculate the interest according to their calculator, because it's the Department of Labor that monitors this particular rule. So
Okay, it looks like that was all the questions.
all right. Well, thank you, everyone. Sorry for keeping you a little long. If you have any additional questions, certainly feel free to contact me or our company, and we'll try to get you answers as soon as possible. And we appreciate your business and your time today.
Perfect. Thank you so much, Steve.